Oil has always been one of the most important assets in the global economy. Almost everything we use depends on energy in some form, which is why oil continues to play a major role in long-term investing. In 2026, oil markets are once again in focus, not just because of demand, but because of major geopolitical changes involving Venezuela. Venezuela holds some of the largest proven oil reserves in the world. For decades, however, political instability, sanctions, and poor management caused oil production to collapse far below its potential. Despite enormous resources, the country was largely cut off from global investment in modern infrastructure. Recently, a major geopolitical incident changed how investors view Venezuela's oil sector. The capture of Venezuela's leadership by U.S. forces created immediate uncertainty and speculation across global energy markets. When political power shifts in oil-rich regions, markets begin pricing future possibilities long before outcomes are certain. It's important to understand that safe investing does not mean betting directly on unstable countries. Direct investment in Venezuelan assets remains highly risky. Instead, safer exposure comes from large, diversified oil companies that can benefit if conditions improve without relying on a single outcome. One company often discussed in this context is Chevron. Chevron has maintained limited operations in Venezuela through special licenses and joint ventures. While Venezuela represents only a small portion of Chevron's overall business today, its existing presence gives it a strategic advantage if political conditions allow expanded production in the future. Another major company is ExxonMobil. Exxon does not currently operate in Venezuela, but its global refining and production network allows it to benefit indirectly from changes in heavy crude supply. If Venezuelan oil flows increase globally, companies like Exxon may gain through broader market dynamics rather than direct exposure. Energy service companies are also worth considering. Firms that provide drilling, maintenance, and infrastructure services tend to benefit when investment returns to neglected oil fields. Rebuilding Venezuela's oil infrastructure would require years of work and significant capital, creating demand for experienced service providers. That said, any recovery in Venezuelan oil production would take time. Infrastructure is outdated, skilled labor is limited, and production cannot be restored overnight. This is why investors should view this as a long-term theme rather than a short-term trade. Oil prices are also influenced by uncertainty. Political instability can push prices higher in the short term, while expectations of future supply can stabilize markets over time. For investors, this reinforces the importance of diversification and patience. Safe investing means focusing on strong companies with global operations, solid balance sheets, and consistent cash flow. Oil exposure should be part of a broader portfolio, not a single bet. Major energy companies and diversified energy funds allow investors to participate in potential upside while managing risk. Geopolitical events like those in Venezuela remind markets how fragile energy supply chains can be. Oil remains essential to the global economy, and disruptions or shifts in production continue to shape prices and investment opportunities. In the end, successful investing is not about predicting headlines. It's about preparing for multiple outcomes, managing risk, and thinking long-term. If you want to understand how global events affect markets and how to invest wisely through uncertainty, subscribe to Smart Hustle Lab for more insights on investing and financial strategy.